Today, the stock market moves national economies, determines the fate of companies, and at times even shapes individual lives. Yet the stock market did not begin as a structured space built on corporate analysis and long-term investment. Its origins were far simpler and far rougher. It began not with what we would call rational investment, but with something closer to placing money on an uncertain future. Now, let us step into that history. In the 16th century, the age of exploration began, and European navigation advanced at a rapid pace. As a result, goods from regions that had once been nearly unreachable began flowing into Europe. Spices, silk, tea, and silver were sold at prices several times, sometimes dozens of times, higher than before. A single successful voyage could create a lifetime of wealth. But maritime voyages were extremely dangerous. Ships were lost to storms. Cargo was seized by pirates. During long journeys, disease spread and claimed the lives of sailors. Even upon arrival, trade could collapse due to betrayal or war. Success was spectacular. Failure meant bankruptcy. Despite these risks, people continued to invest in voyages. The reason was simple. The reward for success was simply too great. At first, wealthy merchants in port cities led the investments. Over time, participation expanded to the urban bourgeoisie, the middle class, nobles, and royalty, and even religious institutions. Early maritime investments were typically funded by a single individual paying for an entire ship. The weakness of this system was clear. If the voyage failed, the investor lost everything. Eventually, people found a solution. Instead of one person bearing all the risk would be shared. Many individuals pooled small amounts of money to fund a single voyage, sharing both profits and losses. This was the birth of the stock concept. In 1602, the Dutch government merged several private trading companies to create the Dutch East India Company. It granted the company extraordinary powers, including a monopoly on Asian trade. Anyone could purchase a share, receive a certificate proving ownership, and, most importantly, sell that share to someone else. This is where the basic structure of modern stocks was completed. Time soon became a problem. A single voyage could take 1 to 2 years, locking investors' money away. Those who needed cash or lacked confidence sold their shares. Others, confident in maritime trade, bought them. As shares were traded repeatedly, Amsterdam became home to the world's first true stock market. Today's stock markets move on earnings reports, disclosures, financial statements, and news. Early markets were very different. The strongest force moving prices was rumor. Stories spread of soaring spice prices in India, fleets lost to storms, and ships that never returned. There was almost no way to verify the truth. People placed money on uncertainty. At this point, the stock market began to resemble speculation more than investment. As price volatility increased, people devised new methods. Why own the stock at all, they wondered, if one could simply predict whether prices would rise or fall? Promises to buy or sell at a future price appeared. Contracts trading only rights, not ownership. Selling borrowed shares and repurchasing them later. This was the beginning of futures, options, and short selling. Rather than evaluating corporate value, these instruments focused on price movement. From the very beginning, speculation was inseparable from the stock market. As markets became more volatile, another innovation emerged: insurance. Instead of absorbing the full loss of a failed voyage, investors paid a fee to protect part of their capital. Marine insurance did not eliminate risk, but it transformed risk into a manageable cost. Modern concepts such as hedging, derivatives, and risk management trace their roots back to this period. Yet even as risk became more controlled, human desire did not stop. People began betting not only on stocks, but on anything that seemed likely to rise in price. The most famous example was the Dutch tulip mania. People traded contracts without ever seeing the tulips themselves. Prices peaked in 1636 and 1637, then collapsed, leaving widespread bankruptcy and disputes. Though tulips were not stocks, the event showed how quickly markets can be consumed by crowd psychology. In 1720, the dangers of the stock market erupted at a national scale. The South Sea Bubble. Burdened by massive war debts, the British government sought a solution through the South Sea Company. People exchanged government bonds and pensions for company shares. Prices soared, then collapsed. Aristocrats and merchants were ruined. Middle-class savings disappeared. Political corruption was exposed, and the cabinet fell. British society no longer saw this as a simple market failure, but as a collapse of national trust. Afterward, deep distrust toward stocks took hold in Britain. Stocks were seen as dangerous, deceptive, and benefiting only the wealthy. This perception lasted for decades. A famous story from this era tells of Isaac Newton. He made large profits early on, re-entered as prices soared, and suffered heavy losses when the market collapsed. He is said to have remarked, "I can calculate the motion of the heavens, but not the madness of men." After the bubble, society began asking fundamental questions. What does a company actually do? Where does the money go? Who is responsible? These questions led to accounting standards, disclosure rules, corporate governance, and investor protection, the foundations of modern securities regulation. The South Sea Bubble left behind a lasting lesson. The stock market does not trade present reality, it trades promises about the future. Those promises can be exaggerated. Expectations can spiral out of control. And when people respond more to stories and hope than to facts, crowds lose their reason. This structure did not disappear with history. The Great Depression, the dot-com bubble, and the global financial crisis all began with overly optimistic visions of the future. When those promises collapsed, markets turned instantly to fear. In this sense, we are not very different from investors in 17th century Amsterdam. In the end, the stock market did not emerge from order or rationality. It was born from uncertain voyages, fueled by human desire and fear. Yet, it endured. It remains the most powerful tool humanity has created to gather capital and experiment with the future. So one question remains. Are we buying the true value of a company or simply another story? Remembering that question may be the most realistic way to understand the heart of the global economy, born from uncertain seas.